Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you once again for tuning in. This week, I'm going to talk about the national statistics released by the Canadian Real Estate Association for the month of August. But before I get into that, I want to talk about how governments, in my opinion, seem to be scrambling to create supply, and the positive and the negative to what I have seen and read lately. Now, let's start off with the City of Toronto. So on May 10th of this year, Toronto City Council approves multiplexes to address growing housing crisis. So now it seems Toronto was the first city to kind of implement these new zoning strategies or bylaws to allow multiplexes in otherwise single family areas to create more density and whatnot going forward. But in the last week or so, there has been many other, including Ottawa, but many other municipalities and cities that have announced similar programs. So let's go over this. I'll give you my thoughts right after. So as we all know, very recently, I think it was last week, if my memory serves correct, according to CTV News here from an article, Ottawa to remove GST on new rental housing, calls on cities to end exclusionary zoning. So of course, more density, exclusionary zoning, meaning they only allow certain types of homes in these areas, usually single families or semi-detached. They want to allow multifamily units for, again, more density, more units, more building. And again, in the same week, we have Calgary. Calgary City Council approves housing strategy. And this was announced on September 16th and updated on the 17th. And Calgary is talking about redoing their zoning to include blanket zoning. So this recommendation now asks to change the default zoning type to RCG, which would allow for single-family homes, but also different housing types. Missing middle housing refers to buildings such as duplexes, row houses, and mid-rise apartments, which can increase density. So we're seeing a common theme here, allowing multiplexes and increasing density, and using inclusive zoning as instead of exclusionary zoning. And again, in the same week, September 15th, there's one more. Vancouver Council approves missing middle motion, allowing up to 8 homes per lot. See a lot of this missing middle, which refers to those homes that are those 4plexes, 6plexes, 8plexes, as opposed to single family, detached, or apartment buildings. This is the missing middle. You're going to hear a lot about this term in the near future as governments and cities try to improve the housing situation. And even in my own city, we have build it or lose it. Niagara Falls prepared to switch from carrot to stick approach to get more homes built. This article was also from last week. Burgess said, while the city has exceeded its 8,000 unit target from an approval standpoint, some of those units were speculative. People like to upzone properties here with no intention of building. So of course, builders and developers like to speculate. They upzone properties, change the zoning, more density, but they don't do anything with them. So my city is preparing to say, look, you're going to lose your building permits, hence lose value on your property if you don't do something with these. Now, many of them had no intentions of doing anything with them. They want to land bank and just let them sit while they appreciate in value, while the housing crisis continues to expand. And of course, one day they can make money. Now, the positive with all these announcements, again, in unison, is there will be more units, and we're going to increase density. We're going to have more units and hopefully help the housing supply. The bad news is these are all targeted towards rental units. They do nothing for building homes for hardworking Canadians who say want to buy a home. They do lots for people who want to rent a home. But if you're purchasing, there has been no announcements. This is kind of, I don't know, I don't want to call it a socialist kind of agenda, but again, these are rental properties. Everything I've read here are all rental-based initiatives and amendments to the zoning. So we've still yet to see how they're going to build affordable homes for average people to buy, first-time buyers, people moving up, moving down, whatever the case may be. That has still not been addressed. Right now, it seems to be the rental housing issue that's being addressed. Now moving on to the national stats from the Canadian Real Estate Association. Their headline, Canadian home sales fall back in August. Statistics released today by the Canadian Real Estate Association, CREA, show national home sales were down on a month-over-month basis in August 2023. And looking at that in their chart format, you can see there the black line is the 10-year monthly moving average. And we were kind of creeping back up to that average sales point, and it has turned around in August, which of course, August is not the greatest month for sales. So sales are still below the moving 10-year average as reported by CREA. And they go on to say, with sales slowing and new listings returning to more normal levels, demand and supply are continuing to come into better balance, said Larry Serqua, chair of CREA. This is giving buyers more time and more choice. August was the first full month of housing data following the Bank of Canada's July rate hike, so a dip in activity was expected, said Sean Cathcart, CREA's senior economist. The demand is obviously still there, and it will be back, but as the housing affordability crisis reemerges as a top policy issue, for now, the slowdown on the buyer's side should help keep a lid on prices. So it looks like CREA is reporting that the tables are turning more towards the buyer side of things. Prices will have a lid kept on them, and there's more supply coming online. Looking at that in chart format, you can see the sales activity is obviously below average there for August. Listings look about average on this chart. They're definitely not low for August. They're not to high point, but they are in that average range. And the supply is almost back to the long-term average. That's the red line. That is the sales to new listings ratio, which show the overall market balance. It's about 56 and a bit percent right now. The long-term average is 55.2. So it is in a very reasonable and average range right now. So supply still overall is very low given the long-term trend, but it is creeping back up in the right direction for a healthy market. Now, this next chart is something that I've talked about many times. It's the HPI. I'm not crazy about indexes, but I want to compare it to the data on average prices just to show you why I'm not crazy about it. And it is a lagging indicator. So here is the year-over-year percentage change on the composite MLS HPI. It's like a price point or like an average price, but it compares through an index format. And you can see there, we've just gone into the positive territory for year over year in August, right at the very end. You can barely see it, but I'm going to compare it to an average chart using the same metrics. And here's the same data over time. I'm just going to zoom in here on the most recent years so we can take a better look. So starting with the composite HPI, you can see the high point was 32% year over year, and that was February 2022. Where the high point for average prices is 43% year over year, and that happened in April 2021. So the composite is severely lagging in that aspect. Now, if we go down to the lows, all the way at the bottom there, the low was minus 15% year over year in February 2023. We actually had the same low month, which was February 2023, but the low was minus 19% instead of that minus 15 on the HPI. Now, looking at the other ones, they're all lagging. Year over year, prices start to decline in October 2022 on the HPI, and they start to decline in June 2022 on the average price point. Again, HPI is lagging by a good few months there. And when we look to the upside, year-over-year increases it just started in August 2023 on the HPI, but on the average price point, it's 4 months in a row now they've increased year-over-year. So they started in May. Again, HPI is a lagging indicator. So again, this is one reason why I don't use HPI. It doesn't give you current information, in my opinion. It is a lagging indicator, and it can lag by up to 14 months, as we saw on that chart. Lastly, I want to move on to the national average residential price by month here. So in August 2023, it was down 2.7% from July this year, or $18,000. It was up 2% from August last year, or $13,000. And it is down 20.3% from the peak, or $166,000. Now, the most recent low was in January this year. It was down 24.5% from the peak, or $200,000. We're closing in on that again. I'm guessing the fall months are going to show some support. I don't know if we'll keep those declines as severe. We may, but it's hard to see at this point. I know interest rates are starting to bite. Actually, how about that inflation today? 4% that just came out. But this winter, I'm pretty sure we're trending to pass those previous lows from last January. So we're probably going to see some new lows in the winter. Anyway, that's it for this week. Thank you for watching. As always, comments down below, and I'll see you next week.